Hey, what's going on, guys? Welcome to another episode of The Curious Cat. I'm going to speak a little more about the Canadian economy today just because there is so much going on, and I feel it's really important to get this information out there as soon as possible, as there is a lot going on in this current situation. So if you haven't already, please subscribe to the channel, hit like on this video, share it with some friends and family who might find this information useful, and it helps me grow the channel and get this information out there. I greatly appreciate any of that. So thank you very much. And with that being said, let's get right into it. So yesterday, the Canadian credit rating was downgraded from AAA status down to AA+, which is a pretty big deal. It means that other nations are starting to question Canada's ability to pay back our debt as we have record high debt levels. So I want to speak a little bit about our currency and why I think we might be entering a currency crisis here in Canada. I have to give you a little bit of history or backstory just so you can understand what's going on with Canadian dollars. So we often compare the value of these government currencies with gold. And the reason we do that is because gold is very scarce and it's hard to create more of. So as you probably know, gold is pretty expensive. If you go to buy a gold ring or gold jewelry or even just some gold bullion, you'll notice that it's quite expensive. And the reason for that is it's very hard to get. If you want more gold, it's very energy intensive. You have to go create a mine. It takes years and years of planning and permitting and billions of dollars to start up a gold mine before you can even break ground. So this is why gold is so expensive. It's very hard to create more of or get more of. And that is what you want when you're trying to hold your wealth in something. You want something that's hard to create more of. So that's the reason why gold historically has held its value better than anything else, because it's not easy to create more of. So as an example, if we had a gold ring and somebody wanted $2,000 for it, but you could just come and hit print on a computer printer and 3D print that same gold ring for free or for $5 of printing fees, would you pay $2,000 for the gold ring? Of course not. It would be very easy to create another one at a low cost. So you can see why the moment it's easy to create something at a low cost or create more of it, that it will devalue whatever the asset is. So that's what's happening with Canadian dollars right now, is they're not hard to create more of. We used to back our currencies by gold. So if the government wanted to create more currency supply, they actually had to go and increase their gold holdings, which meant creating a gold mine. It meant mining gold, digging up more gold, and it was very labor intensive, energy intensive, and it cost a lot of money. So this limited governments from easily expanding the money supply, and that actually had it so our currencies held their value a lot better. But we have in the last recent history, in 1971, we stopped backing currencies with gold. So now there's nothing limiting these governments from just creating more currency supply. And so when they can just come in and just touch a button and add digits to the Canadian money supply, you can see why Canadian dollars start to lose their value. There's nothing that requires them to actually produce more value or to acquire more assets or anything like that. They just essentially come in now and print it or add digits on a computer screen. They don't even actually have to print the cash. There's not even the cost of printing anymore. They're simply adding digits in a digital money supply. So this is what is making the government currencies really vulnerable right now. And because they can just come create more and there's nothing limiting that, it's going to lead to a currency crisis, in my opinion, because right now they're printing money and they're exponentially expanding the money supplies at record high rates, And what that's doing is it's decreasing the purchasing power, the buying power of these government currencies. So if we had gold, you couldn't easily come and double the money supply. You'd have to go and build a mine, like I said, get all your permitting, have billions of dollars to build the mine, to develop it, etc., just to be able to come in and build, or to acquire more gold. So it's not an easy thing to do. But with the government currencies right now, there's nothing that makes it hard at all. They essentially just make a decision behind closed doors that they're expanding the money supply, and they come in and they print more. So this is why it's important to compare the value of Canadian dollars or US dollars, whatever government currency we're looking at. It's important to compare it to the price of gold, because gold is the most fixed asset we have. It's the most stable, essentially, because we know its inflation is very low. So even when they ramped up the production of gold to the max they ever had, inflation was still only 2.7% annual inflation rate of the total supply of gold. So it's a very stable asset to compare stuff to. So we wouldn't want to compare the Canadian dollar only to the US dollar, because the US dollar, they're also doing the same thing in the US, where they're just expanding the money supply. So it's kind of irrelevant to compare it to something else that is just infinitely created with ease. There's nothing limiting them from just creating it. So that's why we compare these government currencies to gold, because it's the most stable, or most stable supply we have. So we know it's only an inflation of 2.7%. So it's a very gradual increase in supply, even if they try and flood the market with it. However, Canadian dollars, US dollars, if you look at the money supply chart, it's going like this, very gradual for years and years. 2008 hits, starts going straight up, and then COVID pandemic hits, it even goes further straight up. So they're just creating so much of it out of thin air. And let's just look at Canadian dollars for a moment. So since 2014, the price of gold has doubled. So what does that tell us? That tells us it takes twice as many Canadian dollars to buy that same ounce of gold in only 6 years. So that essentially is telling us that the purchasing power of Canadian dollars, when compared to another asset that's inflating at 2 to 2.7%, so gold is still inflating, and yet when we compare the price of, or the value of Canadian dollars, essentially Canadian dollars have lost half of their value in only 6 years. So let that sink in for a minute. If you were able to hustle and you were able to get, let's say, 100 grand tucked away in the bank, and you thought you were doing quite well, and in 6 years, only in 6 years, the purchasing power of that 100 grand got cut in half. Now it only can buy $50,000 worth of stuff. So you're busy hustling. Let's see, that's 6 years, 50% decrease in purchasing power. That's almost 10% a year you're losing in purchasing power. So if you make 10 grand a year that you're able to save, and that's losing 10 grand a year, or sorry, 10% a year, that means that 10 grand next year is only worth 9 grand, and then the following year it's only worth 8, and et cetera, et cetera, et cetera. So it's constantly just devaluing. And they're telling us inflation is only at 2 to 5%, which is completely BS. If you look at the charts, you'll be able to see what true inflation is. And inflation is actually easily measured if you just look at the increase in the money supply. So we're being lied to, we're being duped, we're all working for these government currencies, yet they're losing value at an exponential rate. And so this is why it's so important. Very few Canadians are talking about our currency, or talking about money. a lot of people get overwhelmed by finance. They get overwhelmed by the big terms, all the financial jargon, and they just think it's over their head. They can't understand it. So all they do is they end up working for money and they put it in their bank, and that's as far as they go. So if we look at the boomers, a lot of the boomers really don't understand money. A lot of their money or their capital is tied up in real estate. Something like 78% of Canadians own their home. So that means Canadians in general are highly exposed to the real estate market, and they're also holding record high levels of debt. So they owe all kinds of money on these assets that they have in their possession. And that leaves everyone pretty exposed. So the other thing, the boomers have traditionally invested in stuff like, in Canada, RRSPs, or down in the States, what do they call it? Your retirement funds, all that kind of stuff, mutual funds. So they've been told by the governments that this is a good way to save for retirement. So everyone's tucked their money away. And here in Canada, the way an RRSP works is, if you make, let's say, 100 grand and you don't want to pay tax on it all, you could take half of that, or there's some kind of limit, and you can put it into an RRSP and avoid paying tax on it. What they don't really tell people is the moment you want to pull that out and access your own cash, you end up paying tax on it anyways. So the only way you're gaining is if you're putting some money away when you're earning your max earning potential, and you put some into an RSP, and then later on you pull it out when you're not earning any money. Sure, maybe you avoided some tax, but in order to do that, you would have to put money away when you're 30 or 40 years old, when you're earning your highest potential, and then you have to wait till retirement until you're not earning any money. And in this environment, very few people are even able to retire. People are always needing to earn money just to keep up with the cost of living. So there's little hope that you're going to be pulling this money out when you're not earning any money. And even if you are, that's probably after you're 65 or 70 and you're actually able to retire and you no longer have any income. So even if you have a Canadian pension plan or something, you have to take that into account. If you have a pension, a Canadian pension, and other income that's coming in, and you go to pull out your RSP, well, that income is getting tacked on to what you already have, and you're probably going to end up paying tax on it anyways. And in order to do this, you had to put that money away in this RRSP and give the banks access to it. They were able to trade that money and invest it, make crazy decisions, make all kinds of money off of your money, and you had to lock it in these financial assets or financial investment vehicles for 20 to 30 years. And then what did you get out of it? They pay you very little interest. It's probably like 1.5%, if that, if you're lucky. And often they go down 10% in a year if you have a bad year like this past year here where the markets crash. And your money's tied up for these years. And then you go to pull it out. And even if in the end of all this, you manage to make a little bit of money in the end, what people aren't aware of in general is that, sure, maybe you made 50 grand, but that 50 grand in 30 years devalued upwards of 80 to 90% of its purchasing power. So it really doesn't matter. And all the boomers are locked in to the same stuff. They're all locked into real estate. They're all locked into RRSPs. They're all locked into these what else do they have all these investment vehicles that they've really pushed on your average boomer for retirement or whatever, and everyone's locked in. And even if they manage to make some profits with this stuff, all their profits are made in Canadian dollars, and the Canadian dollars are devaluing at an exponential rate. So the way to view how quickly Canadian dollars are devaluing is go and look at some charts. You can sign into TradingView. They have free charts there, and really start to look at some of the numbers here. So what you can do is you can take the Canadian dollar chart, Canadian dollars paired with gold. And if you look at that chart, you'll see the price of gold just started ramping straight up since 2014, and we're now at record high levels. And single ounce of gold in Canada is now something like $2,500, $2,400. I think it came back down a little bit, but we are at all-time highs. And that is showing that Canadian dollar purchasing powers are devaluing at an exponential rate. The graph does go exponential, so that is very alarming. That essentially is showing us that we're entering a hyperinflationary situation. So I am hopeful that we have a slight deflationary period moving forward. No one really knows if we're going to enter a bit of deflation here or if we're going to go right into more of a hyperinflationary situation with all of the money they're printing, but we'll have to wait and see. But what that tells us, when the chart starts going parabolic, the price of gold, it tells us that the purchasing power of Canadian dollars are devaluing very, very quickly. And why that should matter to you is because you're so busy focusing on getting more Canadian dollars, excuse me, on everyone's looking at, oh, I need $1 million in the bank to retire, et cetera, et cetera. But what they're not talking about is that in only 6 years, the buying power, the purchasing power of those Canadian dollars got cut in half. So even if you managed to save $1 million, in only 6 years, the purchasing power turned into the buying power of 500,000. That is unbelievable in 6 years. If that happens in the next 6 years, which I believe it most likely will, then that purchasing power of the $1 million goes down to 250,000, and then in another 5 years, 125,000, et cetera, et cetera, et cetera. So this is why it's important to start learning about inflation and the devaluation of these currencies. Learn what they're doing, how they're manipulating us and enslaving us through the use of their government currencies. And that is why they highly censor any kind of content talking about alternative currencies or a lot of the information that's getting out about cryptocurrencies. Because Bitcoin, let's just talk about Bitcoin for a second, it has a fixed inflation rate. So it has a fixed set inflation schedule that every 4 years the inflation gets cut in half. So when we have all the government currencies printing and creating more money at an exponential rate, and we have Bitcoin that's actually going the opposite direction and decreasing the money supply every 4 years, what's going to happen? As Canadian dollars, US dollars start inflating away in their purchasing power, more and more people are going to look for alternatives. So they're going to start buying gold, they're going to start buying Bitcoin, they're going to start buying silver, and they're going to start ditching the government currencies. No one that's financially educated is going to keep the bulk of their wealth in something that's devaluing at such an exponential rate. You just won't keep up to the cost of living. So if you're going to hold all of your money in Canadian dollars, US dollars, and you're going to expose yourself to this inflation, it's it's not a smart thing to do, as you can see, as I've just outlined. You're going to lose a lot of your buying power, and you're probably going to be at the mercy of rising cost of everything. So the cost of living is going to skyrocket and all of that. The big question becomes, do we have inflation or deflation? Which I've discussed in some prior videos, and I'll make some more future videos on that as well. Just kind of outlining the difference between the two and the potential. No one really knows what we're going to see in this environment. It could lead either way, so it's kind of a wait and see thing at this point. However, it's a really critical time to start educating yourself on what inflation is, what deflation is, what leads to each scenario, and how to watch for it, how to be able to tell yourself what kind of environment we're moving into so that you can make the best financial decisions for you and your family to help protect your wealth and to essentially make sure you have enough resources when we go into these trying times, into these economic crisis situations. Make sure that you have enough resources and capital to put food on the table for your family, to make sure that you can pay all your bills, to make sure that you don't get shaken out of the markets. What they're going to try and do is basically shake a lot of people out of the real estate market. So the savvy investor hopefully has a nest egg or some capital set aside so that if his business is shut down for a while or something, or he's not able to earn money for a bit, that he has some money sitting in the bank to be able to continue to pay his mortgage, so that he doesn't lose one of his most valuable assets in his life, which is his home. So that's why it's really critical to have some money set aside. You want to make sure that you don't get shaken out of the markets. The thing with real estate is, yes, in the long term, it has always gone up because there's more and more people, and there's less and less, or there's always the same amount of land and more people. So supply and demand would say that the price of land will always go up. However, we do get short scenarios where the price of real estate will go down because we'll have stuff like credit crisis, which I think we're going into now, and economic crisis, where a lot of the debt will be called back and people will have to sell stuff. A lot of people won't be able to afford these expensive mortgages because they might have lost their job. They might their economic situation might have changed. So you don't want to be one of those people. If you just spent the last 5, 10, 20 years putting money into your home, you don't want to be one of these people that get forced to sell during this economic crisis. That's what the bankers want. They want you to get shaken out of the market. They want to force you to sell by making it so you can't afford your mortgage payment. And then a lot of the masses will all be forced to go and sell at the same time. And that will create an oversupply of real estate, and we'll have very little demand as the credit markets tighten and the borrowing becomes harder, and it gets harder and harder to borrow money. So there won't be the buyers. And we're going to have all the boomers going to downsize and sell their real estate to fund retirement. And a lot of the people that jumped in too early and bought too high are going to be trying to sell just to afford the cost of living. And in my opinion, that's going to create a huge oversupply in the real estate market. And I think we'll see the tables turn. And you don't want to be one of those people that get caught selling in one of those deflationary situations. You don't want to be selling at the bottom of that when your real estate's worth the least. If anything, you want to be selling right now while we're at a top. If you don't think you're going to be able to ride this storm that's coming, you might want to consider selling now. Or you want to make sure you have enough capital set aside to be able to afford your mortgage regardless. And you want to be able to ride out the storm until the value of that real estate comes back and essentially gets to an all-time high again. So right now would be a great time to sell if you had a lot of real estate. Maybe if you wanted to diversify a little bit, I think it would be a good time to sell because prices are at all-time highs. However, I think the backside of these bubbles are fierce, and I think already people are going to have a hard time selling. Already the real estate market has slowed down. Prices haven't really come down yet, but the amount of homes that are selling has really come down, and so that will eventually lead to a decrease in supply as people are forced to lower their prices if they really want to sell. So that's just a little overview. I hope that makes sense to you guys, why these government currencies are quite risky, because the governments are essentially printing. They're not even printing. They call it money printing, but they're just increasing the money supply. There's very little cash available right now. All they're doing is increasing the digits on the computers. They're just pushing some buttons and adding some zeros to the money supply, and that is devaluing the dollars, and everyone's busy working for them. So educate yourself, learn about inflation, deflation, and learn how to diversify a bit. Maybe learn a little bit about gold, how come it's traditionally held way more value than government currencies. Learn about potentially buying a little bit of silver, a little bit of Bitcoin. But my belief is just to diversify and just kind of spread out your capital so that you're not highly exposed to any one thing. That way if one thing dips down in value, you hopefully won't be forced to sell at a low. You can ride it out because hopefully one of your other investments are doing better, and you can maybe pull a bit of cash from that to afford your cost of living and stuff like that. So I hope that all makes a bit of sense for you guys. Please, as always, leave some comments below if you have any questions or comments. I'd love to hear about them. And yeah, hopefully that all made sense. I hope you guys are doing well out there. Stay well, stay healthy, prosper, and God bless.